Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, I'm Vinay Joseph and welcome to another edition of our weekly podcast, The Week That Was. Now, last week was quite a good week for Indian markets, which maintained its uptrend in a truncated Diwali week, with the Nifty index rising by about 1.2% amid positive global cues as developed markets also continued its rebound from oversold conditions. Less hawkish commentary from central banks and a change of political guard in UK government did help boost sentiment also. The Nifty index is now up nearly 4% for this month and is just about 3 to 4% from its all-time high given the recent rally. However, broader markets have continued to underperform for this week as well for the month, with marginal gains of between 1 to 2%. Among sectors, FMCG was the only sector to end in the red this week, while cyclical sectors like capital goods, metals, and autos saw gains of over 2% for the week. Now moving to the bond and currency markets, the central bank policies and UK political change were the great key drivers this week. The ECB hiked rates by 75 bips in its meeting on Thursday, which was in line with market expectations. However, ECB's comments that substantial progress has been made in removing accommodation, along with reports that maybe some ECB members voted for a smaller hike, were interpreted dovish by the markets, leading to the markets to reassess their rate hike expectations in Europe. Further, in UK, a resolution of the immediate political challenges has given rise to a brief bout of optimism. Overall, bond and currency markets globally as well as in India rallied, with the Indian 10-year bonds posting its first weekly rise in nearly 2 months, with the benchmark 10-year IGB yield down 10 bips in the truncated holiday week to 7.41%. A possible peak in rate hike expectations amid falling yields and weakening US dollar drove the INR lower by 0.3%, but still remained above the 82 handle compared to the USD. So does last week's more dovish commentary by ECB and few other central banks mean that we are close to a pivot in policy expectations? We believe it's still too early, with inflation still running higher than comfort and also growth still remaining above trend. We still see more front-loaded rate hikes coming in the few months. We expect the fund's terminal rate to be closer to 4.5% from today's 3.25%, the ECB benchmark deposit rate to range between 2 to 2.25 range from the 1.5% by June 2023, and the RBI's repo rate also to touch 6.5% from the current 5.9% by the end of this fiscal year 2023. Continued upward shifts in market expectations of central banks' terminal policy rates has raised the risk of recessions for the major economies and obviously increased the probability of near-term downside for equities. So though the markets have bounced from maybe these oversold conditions, we still believe that having a more balanced asset class view and diversifying across asset classes with a greater focus on themes, sector, and tactical opportunities makes sense for the investors in the current cycle. So that's all for this week. Thank you again for listening to our podcast. And if you find it useful, please like and subscribe. Have a great week ahead.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.